Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to rip through Twitter, see what people are talking about, give you my financial opinion on all of it. We're going to be talking about wealth related stuff, financial topics, commodities, stuff like that. I think commodities are in favor. I think that's the spot to be because that's where the value is in the market. Tech stocks, definitely not where the value is. I think we could see a big pullback in technology stocks based off of where interest rates are and the market conditions. So that's where I avoid because the value is not there and there's more risk and the asymmetry is not there, definitely. The symmetry is actually to the downside, not the upside, based off of valuations. So let's dive in, talk about this stuff. If you want to follow me, it's at finding_finance. And if you want to join the website, it's finding-value.com. And that is where we talk about individual companies, portfolio allocation, how I'm doing it, what companies I prefer over others, why I'm setting up a portfolio the way I am, and how I'm playing this commodity bull market, why I'm a longer term investor than a short term trader, because I don't think those guys make any money, so on and so on. And I still have the discount happy birthday that's still in play for 50% off the first month. That discount will be running out here in a couple of days. So the Uranium bull is prepared for a violent upleg in an Elliott Wave 3 move of 3. The current correction is near the end, and it's time to redeploy your funds into uranium miners that soon will outperform the metal. Yeah, so if you look at the charts, we've got this nice big move up on good, strong volume. The pullbacks had declining volume. This is generally where we could see a bottom here. You can even see the stochastics moving on up, and the MACDs are starting to turn around. Yeah, I think he's right. I think we could easily see a move to the upside here in uranium. A lot of the uranium stocks, if you look at individual companies, have broken their falling wedges to the upside, and they've just kind of sitting there. That is generally a good location where I accumulate. In one word, why is America so unhealthy? I just thought this was interesting. I live in Colorado, which is this state right here. And if you look at it, it's 30% to 39%. It's not a win because anyone who gets obese has to move down lower because they can't breathe at high altitude. So basically, a lot of people can't live here because of health conditions, and then they move down to lower altitudes. So I just thought that was interesting. Michael, I like how what he says here. He says 86,000 people follow this doomer who is more wrong than a broken clock. When will the sheep learn he is out for himself? $80,000 a month from YouTube to produce doom porn. Block this guy. Nick Gurley, Reventure Consulting. I just, this guy is unbelievable. That's all I'll say. Patrick says, incredible comeback for Amazon priced in silver, yet still no breakout. Don't get trapped as the chart morphs. Wait for the next confirmed low risk, high reward play. So this is Amazon priced in silver. It's lost over 94% of its value in 670 days for the last bear market, where the market conditions are the same as it is today. An expansionary phase of real estate, increasing interest rates. They declined here because of the recession. They brought interest rates down, blew up the bubble they blew up a bubble in the housing market, and then interest rates went back up, and it really crashed Amazon in terms of silver. That very well could happen again. It looks like that's setting up. We've got a breakdown, a back test, and then we could see a big move to the downside. And that's Amazon priced in silver. So that would probably be a combination of Amazon moving lower and silver moving a lot higher in a combination of those two things. So good chart there. Here's another one with technology. Intel Corporation, many tech stocks giving off similar vibe. He says, be careful here. So this is Intel Corporation. We've got a huge uptrend line for Intel, the break of that uptrend line, and we went down from where we are currently. This is the same spot we've got from number one and number two. It had a 65% decline from there. We've broken the major support line to the downside. We've come up in a rising wedge, very similar to the 2002, 2001 era. And we could see a big move to the downside like it had in 2001 and 2. So that's kind of where I think we're at too. I think we're in like 2001, 2002. There is still the possibility that we have a pullback ahead of us for a lot of these tech stocks. I don't know for 2003 because in 2003 that was kind of like the everything rally occurred during that time frame. But yeah, Intel still has a lot of risk to the downside. And the evidence here is we have a break below major support line. We have a break below the 3-year moving average. We have a break below the Ichimoku cloud. We have bearish rising wedge and a perfect back test of a red line coming back down. So that's the likelihood is that it's going to go lower, not higher. I just want to make a quick comment on this. He says men are expected to now make way more money, but also be 50-50 raising kids and keeping up the house. He says women are expected to keep an Instagram home and perfect kids with no help. It's crazy to battle going on in the U.S. How we stay married. The only thing I'll say is, um, when you ask a lot of girls, what are you looking for? They generally pull out a guy that's taller, makes a lot of money, which is very highly correlated to high IQ, and they want to pass those genes on. A tall guy that's really smart, making a bunch of money. They want to pass the genes, the IQ genes, to their kids, and the we'll call it the genetic height genes. Um, those people, those men are very rare, and they have a lot of options, and they will continually have a lot of options because what the female wants is they want that lifestyle, and that lifestyle and that person is rare. You're looking at like top 1%, or not, maybe not top 1%, but the genetics and all that fit together is like a 1% or 2% likelihood of getting that. And to expect the guy to provide the lifestyle that this female cannot provide herself, to provide the other half of the genetics, and then also expect a 50-50 and all this other stuff, I think that's kind of, I don't know. I don't know if I agree with that. Uh, you have to basically do what you can do in the relationship. I do a lot of stuff that a lot of females cannot do. I save hundreds of thousands of dollars in interest. You buy at the right time for your house. You handle all the finances. You handle all the insurances. You handle everything that's yard work, outside work, anything related to mechanical assemblies. I'm fixing toilets, doing absolutely everything, saving money while also making a lot of money. Um, and this here can drastically be distorted. It's not 50-50, and you do what you can do, in my opinion. And yeah, there are stresses in the relationship that develop when things aren't perceived to be equal. But you also have to realize that if something were to go down and you are older, men's valuations go up when they're the money makers, especially if you're going after a guy who's making 250, 300, $500,000 a year, and you've built that wealth. Uh, and there's got to be an appreciation for that, in my opinion. If a female were to break up and they're in their 40s, their value is basically nothing. It's a lot less in terms of marketplace value for dateability, so to speak. So just be careful, depending on what side you're on. I don't I'm not in this new movement that people say should be 50-50. Um, I think what is highly underrated is I see a lot of guys who, I mean, they make a lot of money. I mean, not a lot, but I know a lot of people who do make a lot of money. They're far rarer than what you think. The value is in the guy, because I don't know that many high earners that are females. And if you want a particular lifestyle that people highly desire, they are going after that lifestyle. They're going after that status or whatever it is. Not everyone, but a lot of people do, and that is where the value is. That's the person who's creating the overwhelming amount of the value in that relationship. And I don't think there's an appreciation for that value as much as what I think there should be. And then there's obviously high value in raising good kids. Um, so yeah, there's all of that to think about. Someone said this. I'll make a comment on it. Zandy, I listened to you for a long time, and sometimes you say things I don't like, but you've provided me with a great deal of value that is undeniable. Thank you for doing what you do, and thank you for the persistence of your information. Yeah, no problem. Appreciate the feedback. let's go into Tavi here. It says monetary and fiscal authorities are currently running unsustainably divergent policies. This simultaneous rise in cost of debt by central banks and their deliberate reduction of balance sheet assets is entirely incongruent with the growth in government debt. So we've got the rising cost of debt. So this is the U.S. interest payments as percent of GDP is just skyrocketing. And then you got the Fed's ownership of federal debt, which is also coming off here. So we're going to look at a bunch of charts here that he's posted in this thread and kind of go over it. I'm not going to read all of this. He's got the U.S. twin deficits to GDP. This is the current account plus fiscal deficit as percent of GDP. We've got the tech bust, which really accelerated to the downside, the GFC that accelerated to the downside, the pandemic recession. We came on up and we're coming back down here again. These are generally slowdown periods in the markets. Tech bust, GFC, pandemic, anything that's falling, we've had a slowdown. So I think we are slowing down as our fiscal deficit as percent of GDP is becoming more negative. Roll down here that he's got, further emphasizes the importance of owning hard assets in this environment. We've got commodities that are incredibly cheap to equities. Each one of these peaks is when the housing bubble has popped. Housing bubble, housing bubble, housing bubble, and housing bubble. If you want to know, we had high inventory of homes in each one of these. If you want to know and look at history. We've got U.S. fiscal spending, excluding interest payments as percent of GDP. So we can see these large increases of U.S. fiscal spending in these areas, and we're starting to do it again. So we've got U.S. fiscal spending as percent of GDP starting to increase. This excludes the interest payments. So it is increasing. It's a form of quantitative easing. U.S. interest payments as a percent of overall fiscal spending. What do we see here, guys? This is kind of interesting. We've got a big move lower. We came up. We hit about 9% here, another 9%. Are we going to break to the upside and break out of this basic bottoming pattern and start to move higher? Where the U.S. interest payments as the percent of overall fiscal spending increases? I think we could, which is really going to add on to the debt. This is U.S. fiscal spending excluding interest payments as percent of GDP. So fiscal spending is starting to overwhelm the amount of, it's becoming a greater percent of GDP. You can also see, you can put a trend line up here and roll it up higher. We could be getting further and further highs and lows moving up and down in this chart here. Coming on down, we've got foreign holdings of U.S. Treasuries as a percent of total debt. We can see that foreign holdings is continuing to decline with time, so they're selling off our debt. We've got U.S. Treasury monthly issuances. This is a lot of issuance of debt on the right-hand side here. So we have less foreign holders. We've got the Federal Reserve dumping debt, and then we're issuing more on top of it. This is basically going to increase interest rates, is what it's going to do. And as anticipated by the market, a significant portion of these issuances is comprised of Treasury bills, which are short-term maturity instruments, very high level. U.S. long maturity debt issuances are a lot lower. So, however, it seems to be off the radar is the fact that there's also been a substantial issuance of longer duration treasuries in recent months. So the U.S. will need to refinance almost half of its national debt in less than 2 years. As a reminder, interest rates were 0% just 15 months ago. So if we have 50% that needs to be refinanced, we are going to refinance that at much higher rates. This is going to get very interesting in terms of debt and interest payments. So the U.S. interest payment on federal debt versus defense spending. Look at this move higher here on the annual interest payments. It is going vertical, guys. And even your annual defense spending is starting to increase. So that's also very interesting. The Fed holdings of U.S. Treasury, you can see they're starting to sell those. And all this is doing is it's going to increase interest rates even further. You have less demand and a crap ton of supply all being sold. So, yeah, it's all very interesting there. Not painting a very good picture. Scrolling down, it says investors are highly likely to be caught off guard as consumer price index starts to accelerate again. leading the U.S. monetary authorities to maintain higher Fed funds rates for longer and even engage in additional rate hikes in the short term. So Tavi's thinking we might have rate hikes continuing going forward, and we could see the consumer price index move higher. Here is John. He says this is First Majestic divided by silver. It's the best timing indicator, he says. You can see a bottom in 2016, big move. We've bottomed here in 2023, and we could see a big move to the upside. And we could also see First Majestic really start to outperform silver here. And that's with silver moving higher potentially. So we could see a big outperformance of a lot of these silver companies. Formula Stock says, what happens when you do not invest earnings in developing new gold deposits? Production goes down, and many costs are distributed across fewer ounces. This is a peak gold story, not a falling energy return on investment story, and a story of management being short-sighted rather than far-sighted. We can see a decline from 2020 all the way outward to 2029. This is Barrick Gold and their projections of where supply is going. So perhaps peak gold supply is here, and we could see a big move in gold price as the supply of gold goes down. It's interesting. So that's what I've got for now, guys. That's where I'm going to end it. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. And that's what I've got for today. So we'll catch you next time. This is Finding Value.